How far could Bitcoin go during the next bull market? I think north of $200,000 is totally reasonable. I don't think that's like bull-tarded hopium by any means. I wouldn't be surprised if Bitcoin stays between 65 and 75K for the next 2 or 3 months. This is a time to be aggressively accumulating, and if we go lower, continue to aggressively accumulate there. But I feel confident that these prices are ones you will never see again in Bitcoin's history.
Welcome to the Bitcoin Dialectic, Mitchell. For those who are watching who don't know you, would you like to introduce yourself?
Hey, thanks for having me. I'm Mitchell Askew. I've worked in the Bitcoin mining space for the past 4 years. I like to talk about all things Bitcoin mining, financial markets. So yeah, happy, I feel like I can cover a wide depth of topics within the Bitcoin world. So happy to talk about anything and everything today.
Yeah, that's along the lines of what I have planned for us today. I have a broad range of questions. So I want to start with what's happening with Bitcoin right now and where we are headed with so many moving parts in the global sort of geopolitical puzzle, but also with the new Fed chairman and with a lot of sort of flux in Treasury companies. So how do you make sense of what's happening with Bitcoin right now?
Yeah, so thankfully, this is not my first bear market. It is my second. So I feel a little more prepared this time around. I think there's a few different dynamics at play. One, you have AI as like the hot new kid on the block, stealing a lot of the potential risk on liquidity. Two, you've got broader market uncertainty because we had disinflation for 2 years, and then this war in Iran caused oil to rise and inflation to start to heat back up right when the market felt like we were on the precipice of interest rate cuts and inflation being in the rearview mirror. You've got that dynamic at play. And then I think you also had a lot of long-term holders, and I don't think this is objective fact when you look at the on-chain data. You had a lot of long-term holders start to sell their Bitcoin holdings in Q4 of last year. And I think there was this self-fulfilling prophecy of the quote 4-year cycle, right? Where a lot of people expected there to be this blow off top in Q4. So they sold in Q4, and subsequently you did get a pretty significant drawdown of 50%. That being said, not nearly as, destructive as previous bear markets, but from a sentiment standpoint, it certainly feels that way, right? It feels as if, similar to how 2022 did when you had a 75% drop in the Bitcoin price. And the reason for that is a lot of the Bitcoin Treasury companies, which you alluded to, they are down way more than 50%, right? And a lot of capital went to those entities instead of Bitcoin itself. And they are sitting on 75, 80, 99% drawdowns even. Yeah. Some of my portfolio too as well. You're not alone in that boat. So there's a lot of different dynamics at play, but I think, from what a lot of the metrics I'm looking at are showing right now, if it's not the bottom, it's pretty close in terms of price. Time-wise, it's to be determined. We could stay around 65K for all of Q3, and it wouldn't surprise me. But I do see Bitcoin as incredible value at these current prices. So I'm trying to DCA as heavily as I can.
Yeah, I think that's hard to argue with. Whether or not this is the bottom, this is incredible value. And Check on Chain does some really good work to explain why that is. You also sort of alluded to the sentiment stuff. I don't know if you've been following the work by Sentiment Sully, like Michael Sullivan.
I know Michael, but I haven't been following what he's tracking in that regard.
Yeah, he's been doing some incredible work just looking at tweets by different cohorts of Bitcoiners and just tracking out what we all feel intuitively, just quantifying the vibes, as Walker America likes to say.
Yeah. Well, the vibes at least the conversations I'm having, the vibes are high, but it's mostly because I'm talking to sophisticated capital allocators that know, hey, you should buy assets when they're on a dip, right? And one of the underappreciated aspects of Bitcoin bear markets is it does wash out the tourist, which means a lot of the conversations you end up having are with folks that are a little more educated on the long-term value, proposition of Bitcoin.
Yeah, that's fair. So we've had a new Fed chair, and he very recently had his first FOMC meeting. So Kevin Warsh sounded quite hawkish in that FOMC meeting. do you think is actually going to be able to implement that in action? And if he does, what are the consequences?
I think he pretty much has to choose between the dollar, which is inflation, or the bond market. And when push comes to shove, I highly doubt he's going to sacrifice the bond market on the altar of a stronger dollar. So it doesn't matter who you put in the Fed chair, right? It could be Jerome Powell. It could be Kevin Warsh. It could be me or you. It doesn't change the fact that there's $39 trillion in debt, and you have well over, I think it's $5 trillion at this point of the annual budget being spent on interest, Social Security, Medicare, and military spending. That's far more than they actually generate in terms of tax revenue. So there's this continual budget deficit. It's a spending problem, and that puts an immense amount of pressure on the Treasury market. The economy will flourish if they can get Treasury rates to come down. Doesn't seem like that will happen organically, right? Big banks like Silicon Valley got burned buying treasuries a few years ago. Foreign countries saw what happened to Russia in 2022, and they have no desire to be net buyers of U.S. treasuries. And so they have, the stablecoin market as potentially like a last-ditch effort to stimulate some more organic treasury demand, right? Because if stablecoins can provide dollars to third world countries that previously didn't have access to dollars, then that's a new pool of capital that could potentially get interest rates down, but doesn't seem like that's necessarily going to get the long rate down, right? All the stable coins are backed by short-term paper. So long story short, the Fed is the only entity that can actually get interest rates back down and stop this 6-year bond bear market. And that will come at a price, which is higher prices across the economy, quote, running it hot, elevated inflation. They just have to get, energy prices contained first. Otherwise, that's going to be kind of lighter fluid on top of an already high inflationary environment. And I don't think they want those two factors at the same time. So whenever this tension in the Middle East unwinds, hopefully sooner rather than later, then I think that's going to give the new Fed chair the green light to start cutting interest rates.
Actually, tension in the Middle East. So US and Iran supposedly have reached a deal. So assuming that the deal holds and oil starts to flow through the Strait of Hormuz again, then in that case, let's say the oil caused inflationary shock does not show up. You still have deflationary pressure from AI. So inflation doesn't sort of remain that big a problem anymore. In that case, so the dichotomy that I see here is like, on one hand, they would want to still at least hold interest rates where they are, which is relatively elevated for the last sort of couple of decades, because inflation is still above the 2% target, right? But at the same time, as you said, there is a bond market, there are treasuries floating around which need to be bought because the US government, like all other governments, is operating on a continuous budget deficit. So is that something that the Fed can do, that they keep interest rates high, relatively speaking, and at the same time do some sort of like QE, some sort of money printing to buy the long dated sort of US treasuries?
I think it's certainly possible, right? We've seen different types of facilities that I would classify them as sneakily injecting liquidity into the system without explicitly saying that's what they're doing. The most obvious example is the BTFP program from 2023. So when Silicon Valley Bank and a few other banks have liquidity issues, they could go to the Fed and borrow directly against the par value of US treasuries, which were actually sitting on major unrealized losses. And functionally what this did is it provided liquidity into the market without them dropping the overnight rate and, spooking the market with inflation still being elevated. You brought up a very important point, which is that AI is deflationary, right? All technology is going to bring prices down. The most, kind of elementary example you could point to is labor prices are dropping because of AI, right? If you're funding a startup, you don't need to go and buy 10 developers. You can buy one and give them a Claude premium subscription. Your costs as a business owner went down. Ultimately, those costs, that force will cause prices across the economy to drop. But that's a problem when you are a government running a deficit, right? Because you want higher prices, because that means higher tax revenues to actually pay down your debt. So while that deflationary force is good for you and I as consumers and entrepreneurs, it's not good for the government. So they're going to actually, in my mind, have to inject some sort of liquidity to offset the deflationary forces of AI. And those deflationary forces are definitely going to accelerate because they're creating a lot of different tax incentives to actually build new AI data centers, and those sites can't be built fast enough.
Yeah, that's fair. What's your take on the whole Bitcoin Treasury Company business right now? So, interesting thing that's happening right now is that SATA is trading at par, so at about $100 a share, which is offering 13% on a daily dividend to like holders. But STRC, Strategy's preferred share, is trading at below 90, and they're offering 11.5% bi-monthly very soon. Currently, it's just monthly. So is this the market telling us that whoever is going to offer the higher dividend or a more frequent dividend, maybe coupled together, is the one that's going to get all the attention, and then this is just a race into higher and higher dividends? Or is there a limit to that?
That's a great question, and I've got a lot to say on this topic. So if at any point I'm getting too far off the beating path, feel free to pause and rein me back in. But I have mixed feelings on Stretch and SATA. I don't think they're like the second coming of God, like a lot of people make it out to be. Digital credit is money. This changes everything. This is more important than Bitcoin. I'm a Saylor disciple. Like, I don't agree with that camp, but I also don't agree with the CoffeeZillas of the world that are saying, hey, this is a total Ponzi. They're never going to be able to pay the dividends. It's a risky asset. I'm somewhere in the middle. Now, you bring up an interesting point, and I think the daily dividends, while I'm not a huge fan of like the branding as this is a money market type fund, I do think that was a good strategic move because it gives you less of this, this behavior where investors want to try to just buy it before the record date so they can get the dividend and then sell it afterwards. So I think it will smooth out the trading volume, which is important for keeping it at par. Now, on the short term, I think Stretch is probably being mispriced at, it's down to $89 a share, because when you look at the balance sheet of the two companies, Strategy, the value of their Bitcoin holdings relative to the liabilities that are, Stretch or more senior in the stack, they have more assets relative to those liabilities than Strive does to SATA, right? So in theory, if one of these were more likely to be paid back, mathematically, it is Stretch. So I do think that gap will be closed, and I think they'll likely switch to daily dividends as well. Now, there's a couple issues I have with these products. One, clearly, they haven't proven the ability to trade at par consistently. And if you're branding something as money market like, or this is stable, it's as good as cash, you can't have a 10% drop, right? Because if I'm a business owner and I put the next 3 months worth of rent and payroll into the money market like product that is Stretch, and all of a sudden the day my short-term liabilities come due, Stretch isn't trading at 100, it's trading at 90, I've got a huge problem, right? It doesn't matter if I got that, 1% monthly dividend, whatever, the 12.5 divided by 12 equates out to, my capital is down 10%, right? So in order for that to really tap into the markets they wanted to tap into, you're going to have to see a little more, of a long-term track record of these things trading at par. And then the second, I guess you could call it, gripe I have with these is they're often presented as these vehicles that are going to totally demonetize the bond market. And they're portrayed as the plumbing, which is going to pull other pools of capital into Bitcoin, right? Because there is objectively a lot of capital in the world that can't buy Bitcoin directly. I don't think Bitcoin gets to 500K a coin, a million, 10 million without products like this. But I don't think these are the final rendition of those products, because it almost sounds like too simple when I say it this way. They're not credit, right? It is equity by definition. Legally, these products are preferred equity. You can call them digital credit. You can call them money market like. You can call it a liability. It is equity. And that leaves a lot of pools of capital on the sideline that can't legally buy equity. If you're managing a bond fund or a pension fund and you have very strict requirements, you can't buy equity, even if functionally it kind of, works like debt, right? You put up this capital, they're going to pay you a dividend. And in theory, if it holds at par, you can get your principal back anytime. That's what it's designed to be. But on, contractual basis, it is equity. And so what I would like to see more of is real Bitcoin backed debt or bonds. So for example, if you take out a Bitcoin backed loan with Ledin or Arch or Strike, those loans being bundled into something similar to a mortgage-backed security and then being sold to the market in bulk. That is like true debt in the legal sense. And that's what would unlock the biggest pools of capital in the world. It's not going to be preferred equity. So I'm not a fan of the way it's presented. And additionally, from the buyer's perspective, we know, because Fong Li, the CEO of Strategy, told us this, most of Stretch volume is retail. Right? It's not going to demonetize these $1 trillion bond markets if it's all retail. And retail within the Bitcoin world, I've been around long enough to see this dynamic play out. There's a tendency to chase the shiny new object, right? In 2017, you had the ICOs. 2021, you had NFTs. 2024, you had Treasury companies. 2025 and 2026, now you have these preferred equities. And it's just like Bitcoin retail plebs like you and I that are actually holding these things. And right now, you should probably just be buying Bitcoin, right? Bitcoin's down 50% from its high. Don't go chase the shiny new object just because all the podcast people are going around talking about it. I would say buy Bitcoin. And, the time to buy Stretch was 8 months ago when Bitcoin was 120K as a chance to de-risk. A lot of the volume and hype around it now, in my opinion, is coming at the wrong time.
That's fair. That's fair. It's also very interesting what you pointed out about Stretch and SATA's audience primarily being just plebs like us, retail, because what that also means is SATA, because it's daily dividend, to an investor, every day is the same. But for Stretch, once it becomes bi-monthly, let's say, there are 2 days where it's something special for the investor. So before the 2 record dates, investors who are piled into SATA right now, they would probably sell SATA, move into Stretch, collect the dividend for Stretch, just like missing 2 days of SATA maybe, and then pile back into SATA. So I see these two products quite closely linked because the investor base is quite similar.
Right. I do think there's a big crossover between who's holding each of these assets. It'll be interesting to see how this shakes out, right? They call it digital credit. I don't think this is the final form of, quote, digital credit. I think Bitcoin has a lot of potential utility as like a capital asset used to back liabilities and, a bit of financial engineering. I'm not like totally against that idea. I just don't think these products are the killer application for that because they are legally by definition preferred equity. That being said, I don't hold Stretch and I don't hold SATA, but I do hold MSTR common stock. I think the biggest beneficiary of SATA will be MSTR common shareholders because Strategy, the company, they get to bring in all this capital and just buy Bitcoin. And over time, if Bitcoin goes up, the dividend rate will go down, right? Right now it's 12.5%, I believe, for Stretch.
11.5% for Stretch, yeah. And
then 13% for SATA, right? The reason this is like what's the 10-year rate at? It's at like 4%. So you're talking like a 7.5 point premium for Stretch. Why is there such a premium over the risk-free rate? It's because investors broadly think Bitcoin is risky. Now, mathematically, I read a fact today. Bitcoin could drop to 25K, stay there for 10 years, and Strategy could still pay all of the dividends for Stretch. So they have such a large capital base actually backing it that me personally, being someone who doesn't think Bitcoin's going to zero tomorrow, I don't think it warrants this significant of a premium. The market doesn't see it that way. But if we're right about Bitcoin, right, Bitcoin's going to go up. It's 60K today. Let's just say it goes back to its all-time high of around 120,000. Now, all of a sudden, that dividend coverage time doubles. And so to the broader market, these products will be less risky. So there's going to be more demand, more volume. And to keep that price at par, the dividend rate will come down. Also, eventually, might not be this year, but at some point, the Fed is going to begin to cut rates. They have to with all this debt. They can also lower the dividend rate every time the Fed cuts. So I don't think that, 11.5% will exist forever. It might even have to go up in the short term, but over the long term, if Bitcoin keeps going up, that rate's going to come down. So I see people every now and then say, hey, I'm just going to like fully port my retirement into Stretch and live off the dividends. Those dividends are going to come down at some point. So it's not something that exists in perpetuity. It's more similar to short-term treasury bills, right? Where the rate can fluctuate on a very short-term basis. So it's not this thing you can just buy and hold and expect these dividends to pay at that high of a rate for the next 10 years.
Yeah, that's fair. This episode is powered by Bitshala. A lot of people discover Bitcoin and then ask, what's next? If you're a developer in India, Bitshala is the answer to that question. Bitshala is a grassroots education initiative run by Indian Bitcoiners to help developers learn Bitcoin the right way. Bitshala offers a paid fellowship to selected participants to work closely with experienced mentors, contribute to real-world open source projects, and build credibility within the Bitcoin ecosystem. If that sounds interesting to you, check out the link in the description. People keep asking me where to buy Bitcoin safely in India. I use GetBit for all my Bitcoin purchases. It's the one I recommend to friends and family as well. GetBit is India's first Bitcoin-only exchange. No distractions, no casino coins, only Bitcoin. You can set up a Bitcoin SIP with GetBit starting at just ₹100, which makes stacking sats really easy. And whenever you're ready, you can withdraw your Bitcoin to your own private wallet for free, so you don't ever have to worry about a hack. If you want to check it out, you can use my code DVJBTC for 30% off on platform fees for the first 3 months. The link is in the description. You are very bullish on Metaplanet as a treasury company. Why is that?
Yeah, so there's a few reasons. First and foremost, they benefit from some pretty significant idiosyncrasies to the Japanese markets. So we have this debt problem in the US. Japan is like 10 years ahead of us on that timeline. So their debt to GDP ratio is north of 200%. We have an aging population, right? We have the baby boomer population getting older while younger folks have fewer children. Japan's already like 10 years ahead of us on that timeline as well. So they have a very indebted government with an incredibly old population that is reliant upon the government to subsidize their living, and they don't have a lot of young people to support the economy. So what this has done is it puts a lot of pressure on the yen. Additionally, their interest rates are lower than ours. So the 10-year Japanese bond, I don't know if they call them bonds, but their 10-year government note has a yield of about 2.5%. So if strategy is, if their benchmark for borrowing is the 10-year US Treasury rate at 4.5%, then Metaplanet in the Japanese market with a lower risk-free rate, they're going to be able to get a lower borrowing cost. And the idea behind these treasury companies is to get levered up to buy Bitcoin, right? Intelligent leverage. Metaplanet is going to be able to get a better interest rate. So I'm confident that will translate to better long-term performance. Additionally, and this is more important, there's a 55% capital gains tax on Bitcoin in Japan. They also don't have Bitcoin ETFs. So Metaplanet really is the best way to get any type of Bitcoin exposure in that market. In the US, you can buy and hold Bitcoin in self-custody. Your long-term capital gains rate is 15%. You can buy IBIT, you can buy MSTR, MSTR options. You can buy any of the, 5 dozen treasury companies that are in the US now. There's a lot of different options to get Bitcoin exposure. Japan is much more limited. And in my mind, that actually gives a very solid reason as to why Metaplanet would trade at a premium to the value of their Bitcoin holdings. During the last bull market, their mNAV, it went over 10x, I believe, at the peak. They were trading at a 10x premium to their Bitcoin holdings, which, that's not going to hold for any sustained period of time. But that's a much higher ceiling than what some of these US-based treasury companies have. And like I mentioned, the risk-free rate is much lower in Japan. The yen has had even higher inflation. And then I have an incredible amount of confidence in their operating team as well. Not that I don't have confidence in Michael Saylor and Fong Li, but let's be honest, they have backtracked on some of the things that they said they would do, right? Last summer, they said they would never issue MSTR common stock below a 1.2.5x mNAV, right? They're still doing that. They said we have this cash buffer to pay stretch dividends. And then all of a sudden, they took that cash buffer and they bought back all their convertible notes. They said we're never going to sell our Bitcoin, which he did say that. And then they sold some Bitcoin, right? And people justify these activities. And I don't necessarily think, within a vacuum, each of these moves were incorrect, but they did go against what their forward guidance was. And so we haven't really seen the Metaplanet team, arguing with plebs on X. They've kind of been heads down, quietly building. They just acquired a company with a Type 1 securities license in Japan. So the Bitcoin-backed bond products I was alluding to earlier, they could actually issue those. They could push digital credit one step beyond preferred equity. Their operating team has been rock solid. So I'm very confident in them, more so than any other treasury company.
Yeah, I actually looked into Metaplanet a little bit, but I was already so far down on my MSTR common stock portfolio that I didn't want to put any more money into treasury companies for a while.
If you're going to do one, I recommend Metaplanet. And they're even at it. Well, I don't offer financial advice, but that's where I'm at personally. And they're currently below a 1x mNAV. I think they're going to be one of the rock stars during the next bull market.
Yeah. I mean, this is just generally a good time to get into anything Bitcoin, whether it is buying Bitcoin directly, whether it's the treasury companies. But I have Metaplanet, I have an eye out for Metaplanet. One thing I wanted to get your opinion on, because when you go to Strategy's website, they publish a list of all the metrics and KPIs and everything that you would need as an investor, right? One metric that is misleading to treasury company investors is the mNAV that they publish, because their formula for mNAV is the enterprise mNAV. It's not the mNAV that you would look at as a treasury company investor to know whether or not that particular purchase is going to be accretive when it comes to Bitcoin per share. This is something that has been flagged many times, but they haven't corrected it. They still publish the enterprise value mNAV, which distorts the ability of a simple investor to just go and know whether or not they're buying Bitcoin at a premium or at a discount. What's your take on this? Why do you think they're doing this?
Yeah, I think you nailed it in terms of the function, right? The enterprise multiple to net asset value also includes the market cap of Stretch, Stride, Strive, Stream, and Strike, the preferred equities. But as you pointed out, the common stock mNAV, so just, not the enterprise mNAV, but the market cap of the common stock relative to the value of the Bitcoin holdings, that's what matters in terms of common stock ATM and whether or not a equity issuance is accretive in terms of Bitcoin per share. Now, the why, to me, they haven't outright said this, but it's pretty clear that it's to support Stretch, right? And maybe if you're the executive team and you're a strategy shareholder, you think that is a good long-term decision, right? Kind of sacrifice a little bit of Bitcoin yield and Bitcoin per share in the short term by diluting the common to provide a longer runway to Stretch. Because the idea is, all right, if Stretch is stable and investors feel confident that those dividends will get paid, then they'll be able to issue more Stretch, which is incrementally more accretive to Bitcoin per share than any other instrument they could tap into.
Just to clarify, when you say that they're doing this to support Stretch, by that you mean that they're issuing MSTR at actually a discount to mNAV so that they can pay off the dividend obligations of Stretch. So in that way, they're supporting it.
Right, because they had this cash reserve. It's funny, when strategy, this is a bit of a tangential point, but when they started this in 2020, Michael Saylor referred to their $250 million US Treasury as a melting ice cube. Now they refer to their cash position as like a strategic dollar reserve. It's a little funny how the language there has changed, but it is, like you mentioned, to provide extra dividend coverage to Stretch. So they had this, cash buffer to provide the dividends for Stretch. They spent a lot of that to buy back convertible notes. Now they wanted a cash buffer again, so the market would be confident that they could pay their Stretch dividends. So they issued common stock in a dilutive manner to provide Stretch with that buffer. And you're having to please two masters, right? the Bible says no one can serve two masters at once. And they have MSTR as a master and STRC as a master. And it's a difficult balancing act to provide support to both of them, right? And over the past month, they have sacrificed MSTR to provide more coverage to STRC. Now, the fanboys that will never second guess anything Michael Saylor does are going to say, well, that's good because the better STRC is, then it's better for the common stock in the long run. And like, that might be true, but the primary KPI is Bitcoin per share. So they have to be expecting that investors are going to raise red flags and have questions when 2 consecutive weeks in a row, they decrease Bitcoin per share, right? I hold MSTR common stock because I believe over the long run, Bitcoin per share will go up. They had 2 weeks in a row where it went down. So if that trend were to continue, I would begin to question whether or not I want to keep DCAing into MSTR. Over the long term, they have increased Bitcoin per share, and I'm confident they'll continue to do that, but it does, raise a red flag, and you have to pause when you see Bitcoin per share going down simply to satisfy stretch and those dividend obligations.
Yeah. Just one more thing on this, and then we'll move on to something else. I've had this thought. So I was having a conversation with Adrian Morris of True North recently, and I know it makes it technically even more like a Ponzi, but why can't strategy just take some of the money that they raise from issuing stretch to pay back the dividend of stretch? Is it just the optics of it, or are there any other problems with it? Because to me, it's just the optics, that it will just confirm the fears of many that it is something like a Ponzi.
The optics would be terrible. I agree with that. But it would also go against the idea, which is that the principal goes into Bitcoin. If we let's make their balance sheet super simple for the sake of an example. Let's say they issue $1 million of stretch and they're going to owe 111,500 a year or whatever, 11.5% is. If they take that $1 million and they go and buy Bitcoin and Bitcoin goes up more than 11.5%, then they could, in theory, sell some Bitcoin to pay that dividend or refinance, borrow against it, right? They're making a positive spread on that. So it kind of defeats the purpose in my mind if they were to take that stretch, buy Bitcoin, and then sell the Bitcoin to pay back the stretch after Bitcoin's gone down, or to issue more stretch to pay back the old stretch holders. So the optics are a little messy, and I also think it kind of defeats the purpose, which is to take that liability, get long Bitcoin with the idea that Bitcoin's CAGR is going to be higher than the 11.5%.
Yeah, I mean, we wouldn't have had to sell MSTR at a discount if the dollar reserve was maintained. So I am one of those who think that the dollar reserve is a very good idea because it just de-risks the whole balance sheet. So you can enter periods where for some reason the market is just not valuing you right. You're trading at massive discounts, and the dollar reserve sort of gives you that cushion.
I agree with that. I think Mark Moss describes it as layers of liquidity. So if you were going to go out and replicate this play on your own and try to be your own Michael Saylor, right? If you borrowed against your Bitcoin stack and bought more Bitcoin, that's basically what he's doing. You would want to have a cash buffer to get through a bear market, enough cash to service the interest on that debt for at least a 2-year timeline, right? That way, if Bitcoin drops and it stays down for a while, you're not SOL having to sell Bitcoin at a loss to pay those dividends. So I do think a cash buffer for them is smart, but they had that and they used it to buy the convertible notes back, which is, again, it's back to two masters, right? You buy the converts back because down the line, if those convert to common stock, that's incredibly dilutive. So it's the convert buyback supports MSTR at, the expense of stretch. And then inversely, diluting MSTR when it's trading at a discount to the mNAV sacrifices MSTR to benefit stretch, right? So when you have these two different masters, it's hard to do something that supports both of them.
Yeah, they're in a bit of a pickle, but I think they'll figure it out. I have hope in the management team. My friend CJ is part of Strategy's team, and I know they're all like really smart guys. They'll figure something out.
Yeah, I have confidence in them as well, and I continuously purchase the common stock, especially at these discounted prices. They have 850,000 Bitcoin. I think they're going to be a massive company by the end of our lifetime. So I'm going to buy it, but it's definitely not something I think newcomers should fully port into. I think people need to build a cold storage Bitcoin position, take self-custody, because that gives you benefits that no Bitcoin treasury equity could ever give you. It is non-sovereign wealth that you can store in your head that has no counterparty risk. To me, that should be people's priority one if they're getting into this space, is get cold storage Bitcoin, understand how the blockchain actually works, set up a multi-sig. Don't move beyond the core Bitcoin principles. Once you've done that and you want to, take some capital and go into some of these higher beta Bitcoin plays, I don't see any problem with that. I'm not like a religious fanatic where buying any treasury company is a scam and, you shouldn't do that. Like, definitely go do that. I do that, but you should also have cold storage Bitcoin.
Yeah. I made the mistake of recommending people to buy MSTR shares because they were like, buying Bitcoin is a bit of a hassle, but they want the exposure. So I was like, yeah, just buy MSTR. And now I get calls from them every now and then asking me about their MSTR position. And I'm just like, be patient, guys.
Right. And if I may quote Saylor myself, a few years back on some podcast, I can't remember which one. I've listened to thousands of hours of Michael Saylor podcast. He said, and I quote, so something along the lines of, I would never recommend someone buy a stock or any investment other than a commodity. And Bitcoin is a commodity, right? It's telling someone to buy Bitcoin is the equivalent of saying, hey, buy land or gold. It is a natural, there's no counterparty risk. There's no third parties. It just exists as a commodity. Bitcoin has a finite supply, just like land does, and gold, not truly finite, but it is very, low inflation with no counterparty risk. So Saylor himself said this a couple of years ago, just recommend people buy Bitcoin. You can't really go wrong with Bitcoin in self-custody for a long period of time. You don't have to worry about a management, messing things up. Not that strategy would, but it's, a non-zero possibility when there is counterparties at play. I don't think buying Bitcoin and taking it into self-custody is that burdensome. I think anybody who can write down 24 words on a piece of paper can do it. So I'm confident people will be able to figure it out, and it'll increase their long-term conviction by actually taking self-custody and experiencing what makes Bitcoin so special.
Yeah. I hope more and more people start to do this. I have thoughts around this, but I'll let that be for now. BIP 110, do you have a take on this?
Yeah, so I am generally not a fan of images and other bloated data being on my personal node. So that being said, if there's some kind of fork, I'm not taking any chances. I'm just going to hold the coins on both chains and let's see where the chips fall. I don't have a super strong opinion, although I do think it is a little conspicuous, the potential funders, of backing behind the Bitcoin Core project. I think Bitcoin Core has definitely gone astray. I recommend running a NOTS node, and I don't want any potential illicit images to be put on my node, so I recommend NOTS personally.
How do you see this playing out? Because sometime in August or September, they have the activation event, which, if it's not successful, if they don't manage to gain consensus, it will result in a chain split. So what happens then? I'm trying to also understand the technicalities of it. So what are the players involved? Who are the players who need to make decisions? And then what are the different scenarios that we can see here?
Yeah, so the chain will likely split. Now, it's going to come down to pretty much which chain miners view as the real Bitcoin. So I am always going to default to the longest chain. The chain with the most proof of work on it is the real Bitcoin. That's what nodes recognize as Bitcoin. The chain with the most proof of work is going to be the ones with the most miners working on that chain. Let's say you're the BIP 110 fork and I'm like the original Bitcoin. Even if you mine the next block faster than I do and the one after that, if miners are still working on the quote, original Bitcoin, and they have more hash power, eventually they're going to catch up. So it's going to come down to which chain has the most hash power, because that's going to be the one that is the longest chain. So whichever one is the longest chain is going to be the real Bitcoin, in my opinion. And I'll be honest, this is my first time where like a contentious potential hard fork has been at play. I don't think there's really been anything like this since the block size war. And people that sold their real Bitcoin to buy Bitcoin Cash got absolutely smoked. Now, people that sold their Bitcoin Cash immediately on the hard fork and bought real Bitcoin basically like doubled their stack size. So it's a high stakes, bet, so to speak. I'm going to play it safe. And when this happens, I will not be transacting on chain for a little while and just, kind of let the dust settle and see which chain ends up being the longest.
Yeah, that makes sense to me. The sitting on both coins, that's what I'm going to do as well, because I don't understand. I don't know what's going to happen. But the question I come to is that you called BIP110 a hard fork, right? Why did you call it a hard fork? I don't think the concept of soft fork versus hard fork is completely clear in my mind. The way I see it is something like a Venn diagram. So there's a space of possibilities. The current chain, let's say, represents this space within that possibility. So the rule set allows these transactions out of all possible. And a soft fork is that you stay within this space. So whatever change you make, it is more selective. It stays within. And a hard fork would include something that was not previously there. So it could include something within, but would also maybe include something, outside of that space. That's the sort of sense I have for soft forks and hard forks. Firstly, is that right?
Yeah, that's accurate. The simplest way to explain it is a soft fork is backwards compatible. So the best analogy I've ever heard to describe this is, imagine you're walking across a bridge, and you could add elements to that bridge, right? Let's say it's just a plain bridge, there's nothing, but then let's say you add a handrail, and then you add a sidewalk, and then you add nice, streamers going across it. It doesn't change the function, right? You're getting from point A to point B. That's kind of like a soft fork. And so you could run an older version of Bitcoin that doesn't have the handrails and the sidewalk and the streamers and still get from point A to point B. A hard fork would be like totally changing the destination of that bridge. Another, I used to play video games, right? And if you got the Nintendo DS, you could plug in a Game Boy game into the DS and play it. So that would be like a soft fork, because you can still play the old version, which is the Game Boy games, versus like when the 3DS comes out, that's a hard fork because you can't plug in a Game Boy game into the 3DS. So if it's backwards compatible, that's a soft fork. Like Taproot was a soft fork. The different types of Bitcoin addresses. So like if you have a BC1Q address, that's called SegWit. That is a soft fork. So you can still use the older legacy addresses and SegWit, and it's totally compatible, versus like Bitcoin Cash, that's a hard fork.
Quick question here, actually. So when we talk about Taproot, for instance, if I'm not wrong, Schnorr signatures were not a thing in Bitcoin before the Taproot fork, right? So if I'm running an old node that doesn't even know what a Schnorr signature is or how to validate it or, check it, how is it backwards compatible then? Because a lot of transactions that will be coming through with a Schnorr signature used to sign them, how would an old node verify that?
That's a great question, and I'm not sure I have the answer for you. But I know you can run an old node that's pre-Taproot, right? So honestly, it probably has something to do with the Merkle tree, right? Where like the hashes are hashed into another hash, and there's just like the header, and that's really all nodes check at the end of the day. They don't go and check each individual transaction hash. As long as the header matches what the difficulty expects in terms of the leading zeros, then nodes recognize that as a valid block. So I would imagine, the Schnorr signatures are tucked beneath that Merkle tree, but I could be totally wrong. And I would recommend asking this to someone who's a little more technical on Bitcoin. I will be honest, that is beyond my realm of expertise.
Yeah, that's completely fair. I mean, I've realized there is so much to learn when it comes to Bitcoin, and a lot of it, until you get your hands dirty, you're only getting analogies. And it's when you get your hands dirty that you realize, okay, this is how the code works and everything. And like, I'm not a tech guy, like,
Yeah.
so I just don't get some of that stuff.
Sounds like you might be. You're asking questions that are definitely, headed down that path, and you're certainly moving far beyond analogies, which is very commendable.
Yeah, I'm trying to learn more. I'm getting more curious about that stuff. I had conversations with Hunter Beast, Ian Smith, so people who are working with like quantum proposals, which is something I want to talk about next.
Mm-hmm.
But yeah, I'm trying to learn more about this. So I was of the impression that Taproot and SegWit were actually hard forks and not soft forks. So that's one thing that maybe you've clarified for me, that they were actually soft forks and that they were backward compatible. You're
Right. So
telling me
when a
that
hard
Bitcoin.
fork happens, that's where you get two different coins, right? That would be, so there would be like a Bitcoin Taproot and you call it a Bitcoin Classic or something, that would both be tradable on an exchange. So because that didn't happen, we know it's a soft fork.
Okay. So again, question here. I was of the impression again that you get two different coins, or you can get two different chains even without any fork or any change in consensus. It could just happen. The two miners, let's say you have Foundry on one hand and you have Antpool on the other hand, that they end up mining blocks independently on top of the existing block. So there's like a change created at the same time, or roughly at the same time. So they both point it to the same block, and then they both keep working on their own block because they want to make sort of their block the canonical blockchain, right? So they keep working on their block and they add one more, and then one of them eventually wins out. So you can have something like a fork even without any change in consensus, just with like miners competing and stuff. That is possible, right?
That is correct. It would not be long lasting, right? So, yeah, I like this example. Foundry mines a block, and at the same time, Marathon mines a block. They both want to keep that 3.125 Bitcoin, so they're going to build on top of their own block. Eventually, all of the other miners are going to they're going to pick a chain to mine on, and one of those chains will get longer and longer. And at that point, it's a losing battle to send your hash to the shorter chain, because you're never going to catch up. And so that's why in the white paper, it's 6 blocks is like where it becomes basically statistically impossible to catch up a slower chain if you don't have a majority of the hash power. So if you're transacting with Bitcoin, buying any kind of good or service, it's always good practice to wait until you have 6 blocks confirmed to confirm that transaction. Because let's imagine you and I send a transaction and it's included in the block on the shorter chain and not the chain that ends up winning out, then that transaction actually didn't happen. So you want to make sure you get 6 blocks after your transaction block.
Yeah. So, okay, that's one thing clarified. The other thing is, in the case of SegWit and Taproot, let's say hypothetically, because I don't know how it actually happened, even if it was a hard fork, even if it was an actual change to the consensus rules of Bitcoin and all nodes had to, let's say, update and everything, even then it is not necessary that you would have a split, because if everyone is agreeing to change their sort of code basically together, then you can sort of together just sort of take a divergent path instead. And that was my image of what happened with SegWit and Taproot, that they were hard forks, but everyone agreed, so everyone forked together.
Yes, but it would have been a hard fork had there been people that didn't agree. That's my understanding. So if there would have been, a non-insignificant cohort of people within the Bitcoin world that rejected SegWit and or Taproot and kept operating a chain without that, then that would have created a hard fork, right? So like the Bitcoin Cash, for example, there was a chunk of people that was non-insignificant that thought, hey, we are going to have 8 megabyte blocks instead of 1 megabyte or whatever it is, right? They wanted to increase the block size radically. There was enough people where there was like actually a market for that different chain. So it sustained itself. You had miners operating on that chain, and where you got this true split where there wasn't really any debate or contention around SegWit or Taproot. And that's the way Bitcoin upgrades need to be. There needs to be broad mass consensus and that's the only way I'm going to be confident about any upgrade, right? And it needs to be a slow process, not rushed, plenty of time to digest it and think about it, and have people much more sophisticated than myself actually diving into the code and making sure there's nothing erroneous.
Yeah, that makes sense. So whether or not BIP 110 becomes a hard fork depends on the response to it. So if everyone sort of gains acceptance or consensus for this, then it won't play out as a hard fork, it will play out as a soft fork. But if it doesn't, and then the chain splits properly, then it becomes a hard fork.
Correct. That's my understanding as well.
Okay, so it's a post hoc judgment of how things play out.
Yeah, it's whatever Bitcoin's kind of unique. It's like whatever the consensus of what Bitcoin is what Bitcoin is. I heard you mentioned checkmate earlier. I'm stealing this analogy from him. I think it's the best description of Bitcoin I've ever heard. It's like chess. If you and I are playing chess and all of a sudden I say I have a super knight that can not only jump pieces, but it can also move like a rook and a bishop. It's like a queen knight hybrid. You're not going to play chess with me. But if I were to convince everyone in the world that this is how chess actually works, where knights can be these super pieces, then that becomes chess. Now, I'm going to have a hard time getting people to change the rules of a 3,000-year-old game. But in theory, if I could get everyone to do that, then that would be what chess is, right? Bitcoin's similar. So if you can get everyone to agree to a rule change, then that becomes like the new Bitcoin. But good luck with changing core key elements to the game. You're not going to get everyone to agree to change from 21 million, from 10-minute block times, from difficulty adjustments every 2 weeks. It's just not going to happen. So Bitcoin is very difficult to change by design. The only changes that typically are made are ones that don't sacrifice what really gives Bitcoin value, which is that finite supply and the fungibility and the ability to actually be used as money.
Yeah, I think that's a solid analogy. I'm going to use it.
Yeah.
I'm going to steal this too.
Shout out to Checkmate. I heard him say that on a podcast years ago.
Yeah, shout out to Checkmate indeed. All right. I want to understand your take on the quantum threat as well. How real do you think it is? How close do you think it is? And how do you think we should respond to it?
It's not real and it's not close, but we should have some response to it. So I did a panel on quantum computing at Bitcoin Vegas, and I was there with Adam Back, who's viewing this as not a significant threat, and then two gentlemen who do view it as a relative threat. And surprisingly, we actually were in like almost violent agreement. And the thing about quantum is currently it really doesn't exist. So what is quantum? It is the idea that instead of bits, which are 1 or 0, you have qubits, which can exist in this perpetual state of being 1 and 0. And so if you have qubits, you can do far more permutations of any type of, string of bits than you could if you're constantly having to check back and forth between 1 and 0, if you can be all these things at once. So the doomsday scenario with quantum is that you could crack every Bitcoin private key, every public key, private key pair. You could take the public key and backwards derive the private key because you can guess and check every permutation all at once by qubits existing in this state of being 1 and 0 at the same time. Now, the problem is they cannot exist in this state for very long. And so you have to have multiple orders of magnitudes more qubits than the string of characters. So, for example, a public key, private key pair is 256 bits. If a qubit can only stay 0 and 1 for a short period of time, you need, I believe the number is 500,000 qubits for a 256 bit, string of characters, right? So you can account for the error and the fact that they don't stay in this state for long. If you way overbuild, then in theory, you could crack a 256 character public key, private key pair. So you need 500,000 qubits. Right now, the most sophisticated institutions in the world are at like 12 qubits. So they're off by a significant amount. So it really doesn't exist, and it's a physics problem, and we don't know for certain if it will ever exist. And even if it does, it's not going to be me that figures it out, and it's not going to be you. It's going to be like an Anthropic or a Google or an OpenAI, some really well-capitalized, large technical institution. And what would happen if they figured it out? If they could get 500,000 qubits and crack a public key, private key pair, well, they're going to pick off these old legacy Bitcoin addresses that have a lot of Bitcoin, right? But if you take, Satoshi's Bitcoin, for example, and try to send it to Coinbase to sell it, that's going to immediately raise red flags. They're going to freeze your Coinbase account, and you're going to have 3-letter agencies knocking on your door immediately, right? So they're going to have to play ball. You're not going to get this scenario where Satoshi's million Bitcoin are taken and immediately sold on Coinbase and the Bitcoin price drops to zero. It's just not how that would functionally play out. So even in the worst case scenario, they're going to have to go through the legal system because that is legally someone else's property, and they're going to have to go through a lot of, compliance to actually try to make any sort of valid claim on that Bitcoin. Meanwhile, if you have a SegWit address, for example, and you've never transacted your Bitcoin yet, your public key, your XPub, hasn't been exposed. So the quantum threat doesn't exist to you. They can't take your Bitcoin because they need your public key to backwards derive the private key. So as long as you're not reusing Bitcoin addresses regularly and your XPub hasn't been exposed, then you don't have to worry about them backwards deriving your public key. So most Bitcoin isn't at risk of quantum anyways. And then the old coins that are potentially at risk, even if you game theory out the worst case scenario, it's not that big of a deal. And then, we've been talking a lot about soft forks and Bitcoin upgrades. A quantum resistant wallet or, Bitcoin soft fork would be created, probably far sooner than actual, quantum would exist as a threat.
So I think the US government is already revealing how it would behave in case any company, whether it's Google, whether it's IBM, whether it's some other company that the US government has any control over, it has already revealed how it would act by its decision to block off Cloud Mythos. So not allowing people to have access to it because it believes it's too powerful and it would be a security threat of some kind to have that just out there. It's obvious that the moment there's a US based tech company that's close to cracking the quantum problem, the US government is just gonna corner it for itself and not allow it to be released or to be used freely. And then if they do decide to attack Bitcoin with it, because that is the lowest hanging fruit here, the US government could decide to take all of Satoshi's 1 million coins and add it to their reserve.
Right. Yeah, that very much could play out if quantum were to ever get to that state. And I like the point you brought up. They're going to keep that technology for themselves. And it's even more interesting than the Mythos example because that is, Fable 5, that could be accessed by anyone because it's software. Now there's obviously a huge hardware backing to all of AI through these data centers, but quantum would be very much a physical thing, right? If you had quantum, you have literally 500,000 of these qubits operating. It is a physics thing. I couldn't remotely access your quantum, computer or whatever. It's it would be a single entity that exists physically somewhere taking up a lot of space. So they could just come in with their guns, software style and take that.
Yeah. There's another matter of, let's say, Bitcoin as a community needs to decide what to do when it forks, right? What's your take on what to do with Satoshi's coins or other sort of lost or abandoned coins? Do we freeze them? Do we let them be? Or do we slow them down to a trickle as proposed by Hunter Beast in Hourglass?
Let them be. That's where I'm at. It's censorship resistant money. We have no authority to freeze or move or do anything to these Bitcoin. And the recent, the last year has shown us that many coins that people think are lost were not. There were coins that hadn't been moved in 7, 8, 9 years that moved on chain as Bitcoin went over $100,000. So you never know who actually holds those Bitcoin. I doubt Satoshi's coins ever move, nor should they. I'm pretty confident Satoshi is dead. I think it was either Len Sassaman or Hal Finney. Not that I'm like big into Satoshi speculation, but I like to pin it to them because they're deceased and nobody can do anything to them. May they rest in peace. But none of the old Bitcoin should ever be touched. And I don't think anything like that would ever happen, right? I think enough Bitcoiners universally agree with that you shouldn't freeze their coins. You shouldn't let them be back in the market to miners. Like nothing like that I don't think will ever happen.
Yeah, I hope so too. I don't like the idea of coins being frozen either. I think Hunter Beast's Hourglass is a very interesting proposal because I don't know if you're familiar with it, but I'll just quickly explain it for the audience if they are not familiar. What he proposes is that we slow down or limit rather the number of these sort of legacy coins that can be moved in any block to one Bitcoin. So only one of the legacy coins can be moved in any single sort of blockchain transaction in a single block, which means that even if there is a quantum attacker who can sort of decrypt your private key from just your public key, even if they want to spend, they can spend 1 Bitcoin per block, which is liquidity that the market can absorb. So there would be no sort of shock to the market if that happens. Worst case scenario, let's say China gets its hand on a quantum computer before the US, and a scenario like that. But also thinking from the perspective of a person who has those legacy coins, who doesn't want them frozen, right? So they can still transact, they can still move, just slowly, but they can still move. So it sort of like balances both things. I don't know what you think of this.
I'd have to give it some more thought. I don't hate the idea. I also don't love it, right? Because you are to some degree censoring someone's Bitcoin, what they can do. You're making it not permissionless. You're only permitted to move 1 Bitcoin at a time. Also, I'm pretty confident if China had access to a quantum computer, they would probably try to take some of the US Bitcoin reserve, but I think they'd also be doing things that are far more destructive, attacking, the stock market and the infrastructure of our banking system.
Fair. Lots to be seen there. I wanted some predictions from you. So, firstly, do you think we've hit the cycle low, or can we go lower?
We can always certainly go lower, but if I were to place a probability on it, I would say I'm 90% confident that 60K was the bottom. We touched there twice. A lot of the on-chain metrics within, there's a confluence of metrics that are all firing at the same time that have only happened at bottom. So you've got miners capitulating. You have Bitcoin below the cost basis of short-term holders. You have the MVRV ratio almost at 1. So the cost basis of the entire network, Bitcoin's almost at that point. And then you have long-term holders are accumulating again. So typically you see capitulation on chain, which is what we saw earlier this year back in Q1. You saw this mass capitulation. We've seen consistent accumulation since then. So there's aggressive dip buying going on. And all of that within, when you take it together, right, you don't want to look at individual metrics in a vacuum, but when I look at all of them together, these are all things that tend to happen at Bitcoin bottoms. So I think the bottom is in price, maybe not in time. Like I mentioned earlier, I wouldn't be surprised if Bitcoin stays between 65 and 75K for the next 2 or 3 months. This is a time to be aggressively accumulating. And if we go lower, continue to aggressively accumulate there. But I feel confident that these prices are ones you will never see again in Bitcoin's history.
Okay. And how high do you think we go in the next cycle?
I don't like the framing of cycles. Like Bitcoin is cyclical as all assets are, but I don't believe it's pigeonholed to a calendar. Right? Bitcoin made a new all-time high before the halving last year. I think that generally kind of debunks the idea that Bitcoin must move in cadence with the 4-year halvings. The relative impact of a drop in supply is significantly less impactful when Bitcoin's already doing tens of billions of dollars of trading volume a day, and miners make 30 million combined a day. So I don't think the halving has too much of an impact on the actual supply demand balance. So I don't like the framing of cycles, but to like run with your question, how far could Bitcoin go during the next bull market? I think north of $200,000 is totally reasonable. I don't think that's like bull tarded hopium by any means, right? We've seen gold and silver make massive moves higher, and they're gold is a much larger asset than Bitcoin, and gold went up like 50% in a 1 month time frame. That's gold was when I got into Bitcoin, gold was like a $10 trillion market cap. I think it's north of $20 trillion now. So the higher gold goes, the higher Bitcoin's floor goes in my mind. So I think $250,000 per Bitcoin within the next 4 years is definitely on the table. An interesting dynamic that's playing out with Bitcoin, we're getting lower highs and higher lows, right? So Bitcoin from the bottom of the 2022 bear market to the top of this bull market was like a 5x. It went from 16K to 125K. It's like a 5 to 6x. Much lower than previous, the previous bear market was like 3K to 60K. That's a 20x. So we're getting less, magnitude to the upside, but also less destructive drawdowns. If 60K was the bottom, that's like a 50% drawdown compared to 75 in the previous bear market and 80 in the bear market before that. So Bitcoin's still very volatile, but less volatile than, beforehand. So if we were to say Bitcoin does like a 3 or 4x off this bear market low, you're still looking at like 180 to 240,000 per Bitcoin, which would be quite the upside opportunity from here. And I think it's very asymmetric too. Bitcoin, the ETF was launched and Bitcoin's price is like $48,000. So the average ETF holder, they're probably sitting at a loss because for most of the 2 years since these things have been out, 2.5 years, Bitcoin's been way over its current price. So I think we're seeing aggressive dip buying at the moment. Institutions are still stacking Bitcoin, right? You have over 100 public companies now that hold Bitcoin. 2.5 years ago, that was like 2 companies. You had Strategy and Tesla that held Bitcoin. That was pretty much it. So I think that, Bitcoin has much, much higher to go over our lifetimes. And, if I gave it any kind of probability, it's like there's less than a 1% chance that we're just wrong about Bitcoin and this is a Ponzi and it goes to zero. And so if you slap that onto an expected value formula, I think the expected value formula of Bitcoin, if it were to reach, gold market parity, it's like, that's like $2 million of Bitcoin. So I think we got a lot of upside ahead of us.
That's awesome, Mitchell. Is there anything that we should have talked about that we haven't talked about yet?
I would say you should stack real Bitcoin if you haven't. If you're listening to this and your only Bitcoin exposure is IBIT or MSTR or Strive or Stretch, you should get some real Bitcoin. It will increase your long-term conviction and strengthen your thesis in those other assets. I also think you should consider a tax-advantaged way to get that Bitcoin exposure. So I think of finance within basically 3 different buckets. Bucket 1 is you need to have assets, right? You don't want to just save in cash. Bucket 2 is you need to have a tax mitigation strategy because taxes are your largest expense. It's not rent or mortgage, gas, food. It's your bill to the IRS. And then layer 3 is you need to think about how you can borrow against your assets to do 2 things simultaneously. 1, your debt will devalue in real terms over a long period of time. And also you can acquire more assets without selling your old assets, right? So buy assets, have a tax mitigation strategy, and borrow against your assets. The wealthiest people in our society have done this, right? These are the kind of the 3 things you need to do to game the fiat system. Don't try to rewrite the rules. Just play, with the rules as they are written. My favorite way of getting tax advantage exposure to Bitcoin is with Bitcoin miners. So you can fully deduct the cost of Bitcoin mining servers in a single tax year. So if I spent $200,000 on mining servers, I can offset $200,000 of active income if you're in the United States. So if you're a doctor, a lawyer, a dentist, someone with a really high W-2 income, you're getting taxed aggressively at very high marginal rates, north of 30%. you're going to want a tax mitigation strategy in play. Bitcoin miners are a great way to get that while also increasing your Bitcoin exposure.
Yeah, that's fair. That's fair. Where can people go to find more of your work and to learn more about the tax mitigation strategies that you mentioned?
Yeah, the best way to get in contact with me is on X. So my handle is at Mitchell Askew, Askew. You can click the link in my bio and learn more information about Bitcoin mining as a tax strategy. You can also shoot me a DM. I'm happy to talk with anybody about all things Bitcoin.
Yeah, that's great. Mitchell, this has been amazing. Really enjoyed our conversation. Love your energy. I love how you speak.
Thank you. I appreciate it. Thank you for having me on the show.